Hello everyone. We'll pick up here in Chapter 7 on the home office deduction. This is perhaps one of the most misunderstood provisions of the tax law, but also very advantageous to those who are self-employed. First of all, for it to qualify, you must use it regularly and exclusively, meaning you have to use it on a regular basis, and it should be used for nothing else. Once you got that qualification, that place of business must be your principal or where you meet with clients or customers. If you meet with clients and customers, you're home free. However, a case went all the way to the Supreme Court, and the Supreme Court ruled that that it doesn't have to be most important that you work at home. You can use it a home office if you have no other place for administrative or management activities to do. So if you send bills, even though you never meet with a customer, or say your customers are always you always meet with customers at their place of business, but you don't have any office at any of their place of business, so you have to have some place at home to do your record keeping and to keep send out bills, that sort of thing. That is sufficient to qualify as home office deduction as long as it is regular and exclusive. So you can either do it one of two ways. You can use the actual method or the safe harbor method. This is one situation where the actual method is almost always better. The safe harbor method, while very simple, is seldom going to give you as much of a deduction as you would be entitled to using the actual method. So you've got to keep track of all of your indirect home expenses, mortgage interest, real estate tax, utilities, depreciation, all that stuff. And what you do is you figure out how much of the home you use exclusively for business, and to do it as a number of square feet or as a percentage of the total, and then you multiply that by these expenses. If it's something specifically for the business, like a separate phone line, that doesn't need to be allocated. That comes out first. Those are what we call direct expenses. If you buy a computer just for the business, if you have a fax machine just for the business, those are aren't part of the home office deduction. This is all done on Form 8829, and this is a little tricky, and we'll look over how this might look. And then there is also a separate podcast on the Form 8829. Up here is where you calculate the percentage of the use of your home is computed. Now, there is a special rule for those who are in child care and provide licensed child care in their home. They do not have to use it exclusively for child care. They can use parts of their house when the children are there and then not use it for that. They don't have to leave it empty during the evening time when the kids are not there. And that special rule allows them to take the number of hours they do use it as a portion of the total hours in a year to figure out what part of that they get to deduct. So that only applies to child care providers, okay? The other area is that you can use, even if you don't use it exclusively, is if you have storage for samples or inventory, then you can deduct that area even though you don't use it all the time, even if it might be used for something else when there's not inventory there. So this is how you kind of divide up. This column is for direct, so usually you're not going to put anything there. This is where all the indirect expenses of the house go. Again, you're going to add them up and then multiply by the percentage of the house that's used for business. Depreciation is down here and then it flows back up there. That's what's confusing about this form, is depreciation kind of has its own little section. And then it comes up here and then gets added in with the rest. All right, now notice this limit. You cannot have a loss from a home office, meaning you cannot have can't deduct more expenses than you have income from the business if you include all the other expenses besides the home office deduction. So it's only going to work for profitable businesses. Otherwise, you have to carry those expenses forward and hopefully deduct them in future years when there is income, but it is you can carry it forward to an unlimited amount of time and money. Safe harbor is very simple. You just multiply by the number of square feet by $5. That doesn't get adjusted for inflation or anything. So, and you can only have it up to $1,500 or 300 square feet. So that's right on the Schedule C. You don't have to file Form 8829. So for those that are under the mistaken impression that the more forms you file, the more likely you are to get audited, they often will elect to do this to avoid another form. That's not necessarily true, but a lot of people believe that. Okay, self-employment tax. This is what we mentioned earlier. First thing you do when calculating self-employment take net earnings for self-employment is 92.35%. Just kind of remember that percentage. Take whatever your profits are from your business, multiply it by 0.9235. Then you pay 15.3%, which is actually two pieces. 12.4 for Social Security on the first $128,400, and 2.9% on everything. There's no cap. So that's what makes this a little tricky, is there's a cap on part of it, but not on the other. So example, if your net profit is $145,000, you multiply by 0.92, okay? You only calculate the 12.4% on $128,400. That's the limit for 2018. And then for all of it is subject to the Medicare 2.9 added together. And then half of that is deductible on your 1040 as a deduction for AGI. Schedule 1. She works part-time and has FICA withheld for $40,200, and then she has self-employment. So only $88,200 more, up to $128,400, will be taxed at 12.4%. Her profit was $105,000. You figure out the 92.35%. You figure out that she can go up to $128,400. She already paid taxes on this $40,200 at her employer. So take the 88.2 times 12.4, all 96 is subject to 2.9. Add that together, okay? Take half of that as a deduction for AGI. This is done on the Schedule SE. First page, you figure out whether you use the short or long schedule. Simple short one is right here at the bottom. The longer is on the back. You have to make more than $400 of net earnings for self-employment, but that doesn't, $400 isn't very much. And on the back, or page 2, if you will, you can see how you would calculate the amount if you have earnings from something else as well as self-employment. It's more complicated, like we talked about, if you have salary from other sources. Retirement plans for self-employed, a little bit. Generally, if you're going to use a retirement plan for yourself, you also have to provide it for any other employees. But many people are they are the only employee, so they don't have to worry about that. They just need to set up the plan, follow the rules according to that. Anything you do for the employees are deducted on Schedule C. Anything you do for yourself is on your 1040. 3 different kinds. Keogh, more complicated, has to be in writing. You've got the maximums there, 55 or 25%. That's a huge number. And you have to make it by the due date. Now, whenever you're talking about how much you put in for yourself as self-employed, you have to do this extra calculation. Take out this share of self-employment tax and subtract the contribution to get your compensation. So it really is the kind of it's an algebraic calculation. So $50,000, 25%. Take the 46, which is, we've already talked about how we get the self-employment part out by taking it by 0.9235. All right. Then you take that times the 15.3, take out, that's your actual self-employment tax. All right, and he subtracts 35.32 for AGI. So his contribution is 25% times 50,000 minus the 35.32 he subtracted minus the contribution. So you have to solve for C. All right, do some algebra, and you get the C equals 92.94. Okay. Another example. Again, you solve for C to get the contribution amount. So it's not as simple as just saying, oh, 10% or something like that. It's sort of involved, even though you started with what sounded like a very straightforward percentage. A SEP has very specific requirements. It must cover everybody as an employee. It's not very flexible, but it gives you quite a deduction, a good deduction but you have to cover everybody, even if they only made $600. The employees do not put money into the plan, only the employer. You as a self-employed person would put money into it for your employees. Basically, the idea is your employees set up an IRA plan and you put money into it. And you get to deduct the contribution that you put into it as a deduction on your Schedule C. They don't count it as income. That's the benefit. That's if you follow these rules. Okay. Simple plans were added to the tax law about 10 years ago to try to simplify things. I don't know that they succeeded in that, but you see the maximum contribution is lower than a SEP. And there are some more rules. You can only do this if you have 100 or less employees. If they're over 50, they can put in extra. They can put in more than 12,005 by 3,000. So you get 15.5. And if you do this, if the employee puts money into, the employer has to make at least some sort of match. And that's where sometimes employers are concerned about putting money in there. All of that money is 100% vested, meaning if the employee leaves at any time, they get to take it with them. So there's not much incentive for an employee to stay with the company. Okay, there's the 100 and fewer employees. It has to be the only plan, and you have to cover all employees that made $5,000 essentially, which is basically means you can't pick and choose favorite employees. You can't pick those that work for you for a long time or any of the other things that you might want to do to reward employees. It has to be for basically everyone that had a reasonable amount of compensation. You know, 5,000 is not that much.